Welcome to the deep dive. Today, we're really getting into a fundamental piece of accounting under IFRS.
That's right. We're talking FIFO, first in, first out.
Exactly. We've looked at quite a bit of material to, properly understand this inventory costing method.
Yeah, and it's crucial. At its heart, FIFO works on this cost flow assumption. Basically, the first stuff you buy.
Yeah.
That's assumed to be the first stuff you sell.
Yeah.
It's about tracking the cost, remember, not always the physical item itself.
Okay. So let's unpack that assumption a bit. Even if, say, a company sells its newest stock first because it's in demand.
Mm-hmm.
For the books, under FIFO, the cost they record for that sale comes from the oldest stock they had.
That's precisely it. And this has some really significant ripple effects on the financials. Think about ending inventory, what's left.
Right.
With FIFO, since the older costs are gone first, what remains is valued using the costs of the most recent purchases.
And, okay, this is where it gets interesting, especially if prices are going up, isn't it?
Absolutely.
Because that ending inventory is then valued at those higher, newer costs, making it look more valuable on the balance sheet.
You got it. Higher ending inventory value. Now, let's flip over to the other side. Cost of goods sold, or COGS.
Okay.
If the first costs in are the first costs out, then COGS uses the cost of that older inventory.
And if prices were climbing when that older stuff was bought, it would have been cheaper. So COGS looks lower under FIFO in that rising price situation.
Exactly. Lower COGS. Now, think immediate impact. Lower costs against your revenue. What does that do to profit?
Well, less cost means more profit, right? So higher net income. FIFO can sort of inflate profits when prices are rising, makes the company look potentially more profitable.
It can. And, that higher profit isn't just a number for show.
Ah, right. Taxes.
Bingo.
Yeah.
Higher net income usually means higher taxable income, so potentially a bigger tax bill.
Ooh. Okay. So while the profit picture might look good in rising prices,
Companies have got a budget for potentially higher taxes. It's a real cash flow consideration. Might even affect, how much inventory they decide to keep on hand.
that's a great point about tax strategy. Now, something I often hear about FIFO is its simplicity. Is that fair?
It is, generally speaking, compared to, say, weighted average. FIFO is often easier to understand and implement.
Fewer headaches, maybe?
Fewer headaches, potentially lower accounting costs, fewer chances for mistakes. So yeah, simplicity is definitely a plus.
And it seems like sometimes it's not just an accounting choice. It actually mirrors what's happening physically.
For sure. Think about a grocery store with milk or a bakery.
Right, you want to sell the older stuff first.
Absolutely. Perishables, things that go out of date, or even fashion items that become obsolete quickly. In those cases, FIFO actually reflects the real-world flow of goods.
So the financials are more representative of reality in those industries.
Exactly. It aligns well.
And just to confirm, IFRS is okay with FIFO. No issues there.
Yep. Perfectly acceptable. It's permitted under IAS 2, the inventory standard.
Good.
But there's a key rule in IAS 2, consistency. If a company has inventories that are similar in nature and use, they have to use the same cost formula, like FIFO, for all of them.
Ah, so no picking and choosing methods within similar stock just to make the numbers look better.
Precisely. It's about consistency and comparability within the company's own reports.
Makes sense. And speaking of comparability, do companies have to tell us they're using FIFO? Is it disclosed?
Oh, absolutely. IFRS insists on it. Companies have to disclose their accounting policies, including the inventory costing method used.
So investors and analysts can see how they're calculating things.
Exactly. It helps users understand the numbers and try to make comparisons between companies, even though, comparing across different methods is still tricky.
Okay, right. We focused a lot on rising prices. But what about the flip side? What if prices are falling? This feels like a really critical point.
It's absolutely critical because
Yeah.
everything we just discussed basically reverses.
Reverses. How so?
Well, think about it. If prices are falling, that older inventory you bought earlier was more expensive than recent purchases.
Ah, okay.
So under FIFO, your cost of goods sold will be higher because you're expensing those older, higher costs first.
Higher COGS and the ending inventory.
Valued at the more recent, lower costs. So lower ending inventory value.
And the bottom line impact.
Lower COGS.
Higher COGS, lower profit.
Exactly. Lower net income. So you see, FIFO doesn't inherently make profits look better or worse overall. It depends entirely on which way prices are moving.
Wow, okay. That's a really important distinction. The higher profit scenario isn't guaranteed. it flips completely if prices drop.
That's the key takeaway on price fluctuations.
Yeah.
Now, another really important IFRS concept ties in here: net realizable value.
NRV.
NRV.
Right.
Yeah.
The lower of cost or NRV rule.
Exactly. Inventory always has to be reported at whichever is lower, its original cost or its net realizable value.
And NRV is basically estimated selling price minus any costs needed to finish it and sell it. Like if goods are damaged or need extra work.
Perfect definition. So if market prices drop or goods get damaged, their NRV might fall below what you originally paid for them.
And you have to write the inventory value down.
You do. Now, here's a specific IFRS wrinkle. If you write inventory down to NRV, let's say from $10 cost down to $7 NRV,
Okay.
and then later maybe the market recovers and the NRV goes back up, say to $12.
Can you write it back up?
You can write it back up, but only up to the original cost.
So in that example, only back up to the original $10, not the full $12 current NRV.
Correct. The original cost acts as a ceiling for reversals of write-downs. And this lower of cost, or NRV principle, applies no matter what costing method you use, FIFO, weighted average, whatever.
Got it. That's a subtle but important point. Now, you mentioned comparing companies using different methods is tricky. Why is that such a big deal for, say, an investor?
Well, it really muddies the waters for direct comparison. Imagine two identical companies in the same market. One uses FIFO, the other uses weighted average. Especially if prices are moving, the reported COGS, their gross profit, their net income, they could look quite different, purely because of the accounting choice.
Even if their underlying operations are the same.
Exactly. So anyone analyzing them needs to be aware of this, adjust for it if possible, or at least understand why the numbers might differ. You can't just take headline profit figures at face value.
So it requires a bit more digging.
Definitely requires digging deeper. It highlights why disclosure of the methods is so important.
Okay, so summing that up, when does FIFO really make the most sense for a business? Where's its sweet spot?
Well, generally it's best where inventory items are distinct and you can easily track their purchase dates and costs. Like, you know exactly when lot A arrived versus lot B.
Traceability.
Traceability, yeah. And as we discussed, it's particularly good when the physical flow actually is first in, first out.
Like the bakery, the groceries.
Perishables.
Perishables are the classic case. Or industries where the first version needs to sell before the next one comes out. And underlying all of this, it sounds like meticulous record keeping is non-negotiable.
Oh, absolutely fundamental. You need accurate, detailed records of what you bought, when you bought it, and what it cost. Without that solid foundation, FIFO calculations just, well, they fall apart. Garbage in, garbage out.
Right. Makes sense. Okay, so let's try to pull this all together. FIFO under IFRS. It's a widely used method. It's based on this core assumption that the first costs in are the first costs out, impacting COGS and ending inventory.
Right, which then flows through to net income and potentially taxes.
And crucially, the direction of price changes up or down massively influences whether FIFO results in higher or lower profits compared to other methods.
Can't stress that enough. It's very sensitive to price movements.
We also need to remember it often matches physical flow in certain industries, like perishables, which is a plus for realism there.
True. But we always overlay that lower of cost or NRV rule.
Right, that's universal. And comparing companies using different methods like FIFO versus others, well, it requires care.
Careful analysis, yeah. Understand the method to understand the numbers.
So, FIFO. It seems simple on the surface, but the implications for financial statements are actually pretty significant and nuanced.
Definitely. It's a great example of how an accounting choice can shape the financial picture a company presents.
Okay, so maybe a final thought for you, the listener, to chew on. Given how sensitive FIFO is to price swings, how might a company strategically use its choice of FIFO? Could it influence how they price their own products, or maybe when they decide to buy inventory, especially if they think the economy or prices are about to shift? Something to think about. Thanks for joining us on this deep dive.